Okay, good morning. It feels like we had spring break or something, at least for me, because I didn't have to take the exam, right? But anyways, so today we're going to start on Chapter 5. We have a question in Learning Catalytics, which is actually related to Chapter 5. Chapter 5 is the first of our content chapters. You'll notice that we skipped Chapter 4. Chapter 4 is about cash and internal controls. We're going to only do a little piece of Chapter 4, so I'm going to save Chapter 4 for a couple weeks because we're only doing a little piece of Chapter 8. So we're going to do 4 and 8 together in a few weeks. But so today we're starting Chapter 5. And what we're doing is we're starting several weeks of working our way through the balance sheet. So we're going to start today with Chapter 5, which is about short-term investments and accounts receivable or receivables. And so we start out with this question about what kind of account is accounts receivable. And accounts receivable is actually, I think we were up to 93% of you were correct, so maybe the other 7% can correct your answer. Accounts receivable is an asset. It's a current asset. It's near the top of the balance sheet. We start a balance sheet with cash and then do our short-term investments, and then typically somewhere in there accounts receivables are up there. So we're going to start talking, we're going to talk about investments, short-term investments today, then we're going to start talking about receivables, and then Wednesday we'll finish up the chapter. So the question will be out there for a little while still, so if you're just joining us, get logged in and answer. The Chapter 5 homework is due this Saturday. We're back to a regular homework schedule. And so exam average, so talking about the exam. Exam average was 72.5, actually higher than it was last year, so that's great. There were 7 people who got a perfect score on the exam, so that's wonderful, and then there were lots of people that were up in that range. If you'd like to see a list of the scores, there's 607 students, I believe, who took the exam. You can download that Excel file so you can see where you rank in relation to it. It's http://tiny.cc/scores/spring2016, all one word. You'll need to save the file and reopen it with Excel, but you can see the list of scores. It's sorted from highest to lowest. Of course, there are no names on it. So there's the score. So now that you've experienced the first exam, the next 2 exams will be similar in structure. So you know what to expect. The next 2 exams have practice exams as well, very closely aligned with the actual exam. And the next exam tends to be, not to scare anyone, tends to be the exam that's the hardest for most people because we're getting into some very picky content. And so this is going to require some effort. Also, the next exam, even though it's not cumulative, it builds on prior content. Just like I just asked, what kind of account is accounts receivable? This material assumes that you know what kind of accounts are, you know debits and credits. So what it's doing is it's taking the last material and building on it. So if you struggled with the first one, then it's going to be a little more struggle. But that said, I always have people who are able to improve their score from exam 1 to exam 2, so it's not a lost cause. So if you want to see your exam, you can do it this week. It's a one-week offer. Amir typically does not have time in his regular duties working for me to have office hours, but he's going to have office hours this week. I'll be emailing this out in an announcement this afternoon, but he will be available from 12 to 3 on Wednesday and from 10 a.m. to 1 p.m. on Thursday. And you don't need to make an appointment. You just show up. He will be in room A230, which is past the computer labs where you took the exam. So if you walk past the computer labs where you took the exam, then there is a lab past there. It looks like what's on the screen right now. When you walk in the door, you'll see all these computers, and he will aim to sit back in that corner. So just look for him. And again, no appointment necessary. He is available Wednesday, 12 to 3, and Thursday 10 a.m. to 1 p.m. I would urge you, if you didn't do what you thought you were going to do, I would urge you to go see him, see your exam. So we do this split duties here. So he goes over actual exams with people, and then after you've seen your exam with him, then come, if you want, come and talk to me. We can talk about how you prepared, things you might do differently. So if you want to do that, that's fine. But to see your actual exam, that would be this week. Oops, I went back. That would be this week from 12 to 3 on Wednesday, 10 a.m. to 1 p.m. on Thursday. No appointments necessary. And I will email this out again this afternoon so you know that it's there. Okay, so with that, we're going to start with Chapter 5. Chapter 5 is about short-term investments and receivables. So we're very near the top of the balance sheet. We're right after cash. So we're going to do short-term investments. So we're going to be coming up, we're going to be doing inventory, then we're going to be doing long-term assets, working our way through all the assets each week, and then we'll end up doing liabilities and equity accounts. So that's kind of what we're going to spend the next several weeks doing, looking at the different sections of the balance sheet and what composes these assets. So short-term investments and receivables. This is Coca-Cola's balance sheet. We're going to be talking about short-term investments, marketable securities to some extent, and then accounts receivable, which is the next line down. This is just a shot of Coca-Cola's Form 10-K. If you don't know, a Form 10-K is filed by a company every year after its year end, whenever that might be. A Form 10-K is filed with the Securities and Exchange Commission, the SEC, and every company that is publicly held is required to file a Form 10-K. And a Form 10-K can be quite long. I think on average they're about 100 pages long, but in there, there's items 7 or 8 in there are all the financial statements of the company. So you can find the balance sheet, the income statement, all that stuff in the notes of financial statement. So we're just going to be working our way through short-term investments and accounts receivable in this chapter. So short-term investments. And once again, if you have the PowerPoints on Blackboard, they're a lot more detailed than what I'm showing on here because I'm putting the major points on here that I want to call attention to. But those PowerPoints have a lot more detail on them. So short-term investments. Short-term investments are considered a current asset. And then there's 3 categories. We're going to be talking about the trading securities in this chapter. But for right now, what you need to know is you need to know there are 3 categories. The 3 categories are trading, available for sale, and held to maturity. Okay. So trading securities, when we're talking about these securities in general, what's happened is the company has some excess funds. So they have excess cash, and they want to put their money to work for them somewhere, so they will take excess cash and put it in one of these types of investments, perhaps. And so the types of investments, the types of categories that we'll see on the balance sheet would be trading securities. And these are trading securities, maybe the company says, oh, we have a little bit of cash or a lot of cash for a short period of time. We're going to buy this investment and we intend to sell it very fast. So trading securities, these are actively traded. We're buying it to trade it. So we get in, we buy something, we intend to sell it soon. So those are trading securities. The next category is available for sale. And this is where we make an investment and we don't have an intention to sell it really fast, so we'll call it available for sale. But we could sell it if the time is right or if we need the money or something, but we don't have this intention to sell it immediately. So that's available for sale. So if a company buys stock in another company, it's going to be available for sale, or trading security, one of those 2 things. So we buy stock in another company, it's going to be one of those 2 things. There's also another category called held to maturity. Held to maturity is when we invest in bonds. So when we invest in bonds, they can be bonds of the U.S. government, U.S. Treasury bonds. They can also be bonds in another company. There's a big news story out in the last couple of days about Toys R Us. Toys R Us has a junk bond rating, which means they're higher risk than obviously the U.S. Treasury bonds, but Toys R Us has a junk bond rating, which means they have to pay a higher interest rate than a company with a really good credit rating. And when they give companies credit ratings, they analyze their cash flow and their profitability and all these things. So Toys R Us pays a higher rate, but Toys R Us is going to do another bond issue to pay off some current bond stuff that's coming due. So when companies can issue bonds, but other companies can buy those bonds and hold them as investments. So in this chapter, we are looking at investing. So we're buying other companies' stock, we're buying other companies' bonds, or U.S. Treasury bonds as well. So we have those three categories: trading, available for sale, and held to maturity. I will tell you right now, you should have those three categories written down because we're going to have a question, a true-false question that says these are the three categories. Okay, so know the three categories. Trading securities are going to be the big focus of what we do in this chapter. We're going to get to a later chapter where we'll look at held to maturity, but you need to know the three categories right now. The difference between the first two categories is intention. Do we intend to sell this rapidly, or do we intend to just kind of hold on to it and sell it when it makes sense, or do we intend to hold it to our maturity date? Only bonds can be in the last category, but bonds can be in the first two categories. In stock, another company has to be in one of the first two categories. Okay, so that said, we've got some examples of what we're talking about when we talk about investments in trading securities. So trading securities, let's say that on June 18th, Apple purchases 5,000 shares of Intel stock as a trading security. So right there you're told we're doing the accounting for Apple because we're looking at this as an investment. And it says that they buy it as a trading security, which means they have this intention to sell it pretty quickly. For simplicity, assume that Intel stock is Apple's only short-term investment because that makes our life much easier. And Apple buys the Intel stock during the year for $20 a share, paying $100,000 cash. So when we record this investment, what's going to happen is we're going to debit investment in trading securities, which is a current asset, a short-term asset. And then we're going to credit cash, and we have a memo line for purchase investment. So that's it. When we make this purchase, we're debiting the investment account, we're crediting the cash. So there's a couple transactions we need to know. That's one. We purchase the investment. We purchase the investment, it goes into the investment account, current asset, and it comes out of cash. We pay cash for it. Okay, so that is one type of investment transaction when all we're doing is shifting from cash into another short-term asset. So another thing that can happen, when we own stock in another company, we being, in this case, Apple owns stock in another company, it can receive dividends. And when it receives dividends, this is called dividend revenue. So our next example, let's assume that on June 30th, Apple receives a $4,000 cash dividend from Intel. So what it's going to do is it's going to debit cash and it's going to credit dividend revenue. Okay, a couple weeks ago, I told you that when you see the word dividends, it's never on the income statement. That's because when you see the words dividends or dividends declared, that means It's our own stock that we're paying dividends on. So that would be if Apple declares a dividend, if we're talking about doing Apple's accounting here. Apple declares a dividend and pays a dividend out. Cash is going out. Dividends are considered a distribution of equity. So that's never on the income statement. This case is where we're earning dividends, we're receiving dividends on stock that we own. This is not our own stock, but this is dividends received on stock that we own, and we have dividend revenue from that. So that works. So this is where this does show up. Dividend revenue shows up on the income statement, but it's revenue on investments we've made. Okay, so far we said, here's what happens when we purchase an investment, and here's what happens when we receive dividends on stock we own. The next thing that can happen, and we're in trading securities, so that's important to know. We are in trading securities, so we're talking about trading securities. We had a basic principle in the first couple weeks of class called historical cost principle that says when we buy something, we record it at its historical cost, and then we keep it on our books at historical cost. And that's true for most things. However, for trading securities, we are going to mark these to current market. So this is where we're going to say, what's the current market value? And then we're going to reclassify that. We're going to have something called an unrealized gain or loss. Okay, so the word unrealized, that is a key point here. This should be prominent in your notes for today. It should be prominent in your notes for Wednesday. It should be prominent in your notes for exam. When you see the word unrealized, it has a very specific meaning. Unrealized means we have not sold this investment. We still own the investment. We have marked the investment to current market value. Okay, so trading securities, what we do is at the balance sheet date, so at our financial statement date, we're going to go in and we're going to get the market value of these trading securities. So we're going to look up in the Wall Street Journal, what is this security worth at that date? So at that date, we're going to say, okay, we are going to change the value of that investment on our balance sheet to the current market value. And the reason we do this is because this is a trading security, and we plan to sell it very fast. So we want our balance sheet to reflect its current market value. So note how I have current fair value and market in parentheses. We can talk about current value, we can talk about fair value, and we can talk about market value. And for our purposes in here, those are all going to mean the same thing. That's we go to the Wall Street Journal, we look up the current market quote, and that's what we're talking about. So we are going to take these trading securities that we still own, and we're going to mark them to up to market or mark them down to market, but we're going to record them at fair market value or at fair value. The word unrealized means that we still own this because we want to be very clear with users of our financial statements that we're recognizing a gain or loss, but we still own the underlying investment. So we have to delineate between a transaction that's actually happened and this marking to market that goes on. Unrealized. You see the word unrealized in your notes should be not sold yet. Okay, unrealized automatically means not sold yet. We still own it. Okay, very specific terminology. So guaranteed you're going to see several questions today with the word unrealized in it. You need to know what that means. You're going to see it on the exam. Got to know that word unrealized, what that means. Okay, now if fair value has increased, so what that's saying is the fair value, what it's worth today, is worth more than what you paid for it. So would that be an unrealized gain or loss? If it's worth more today than what you paid for it. it's going to be an unrealized gain. So again, this isn't something necessarily you have to memorize. I think people get caught up in trying to remember the formula with unrealized gain or loss. If you think about it, you're saying fair value is what it's worth right now. Is that worth more or less than what you paid for it? Well, if it's worth more than what you paid for it, you have an unrealized gain. And then conversely, if the fair value has gone down, you're going to have an unrealized loss. Okay? So again, I would urge you to think through this rather than memorize it about the fair value versus the cost. So fair value has increased, you have an unrealized gain. Fair value has decreased, you have an unrealized loss. Okay, so everyone has unrealized means not sold yet. Okay, that's the big takeaway. Unrealized means it has not been sold yet. Okay, so let's go through a little example. Apple has a weird financial year. Lots of companies do, a weird fiscal year. Theirs ends something like on the 4th Friday of September, so the date changes year to year. So their year end on this particular example, September 27th. On this date, the fair market value of Intel stock is 110. Remember that Apple paid $100,000 for this stock. So its original cost is $100,000. It's currently worth $110,000, but Apple still holds the stock. So this is unrealized, number one, because they still own it. And number two, if we're looking at whether this is a gain or loss, we say, well, it's worth $110. We paid $100 for it, so we have an unrealized gain. So what we're going to do on this is we're going to have the $10,000, which is the difference between what Apple paid for the stock, $100,000, versus its current market value, $110,000. So $10,000 is the increase in investment in trading securities, and we're going to have an unrealized gain for the other side of this. So what's happening in terms of accounts? We started out before this adjustment, the investment account, the asset was $100,000. So now what we have is we're writing that up. We want the investment account to be $110,000. So we would have $10,000 that we're adding to the investment account and giving us $110,000 in our asset, and then we have an unrealized gain for $10,000. Okay, so that is an unrealized gain and loss. Okay. Okay, now, realized gains and losses. So if it's not unrealized, it has to be realized. And I'm just going to do, I guess I'm going to cross this out, but it's still there. You don't typically see the word realized. I put it here to be the opposite of unrealized, but if something just says gain or loss, that means it was realized. It means that the underlying investment was sold. So realized means it was sold, but you don't normally have the word realized, except in exercises in your book. You don't normally see the word realized in real life. It's just gain or loss. If it's just plain old gain or loss, then we sold the investment, so that tells the investor this really happened. We actually did realize this gain or loss. So again, sales price is greater than carrying amount. And I would not memorize the sales price greater than carrying amount. Think about what you have. If you say what I sold it for, is it more than what I was carrying at? Carrying value is like its book value. It's related to its original cost. So did I sell it for more than the carrying value? If so, I'm going to have a realized gain. I'm just going to call it gain though. It's not going to be realized. It's not going to be realized gain. It's just going to be the word gain, but it's considered to be realized because we actually sold it. And then the sales price, if it's lower than the carrying amount, we have a realized loss. Will they have a question like? You have drop-down menus, yeah. I don't know if it'll ask you for realized gain or gain, but it won't have both. So you'll have there. If I don't remember if that's consistent either, but yeah, you will not have to choose between that. You would have to choose between unrealized and then either realized gain or gain. They mean the same thing. Okay, so let's assume that Apple sells its Intel stock, so now it's actually selling the stock for 107. Assume that the carrying value for the stock or the book value is 105. So we're just giving it a carrying value of 105. If you have the slides that you downloaded, I added the sentence about assuming that the book value for the stock is 105. So that's where the 105 came from. It's an assumption. So we sell it for 107, so we're getting cash in. We're going to credit the investment for 105 because that was its carrying value, the assumption we're given, and then the difference is gain. And notice it just says gain on trading securities, and it's different from the account that says unrealized. If it says unrealized, we still own it. Okay, now, remember a couple of minutes ago when I said, here's the 3 categories, and you're going to need them? So that's where we're going next. Okay, short-term investments can be divided into, and they're in a different order here, held to maturity securities, trading securities, and available for sale securities. Is that true or false? Okay, so again, even if they're listed in a different order, that's okay. Are those the 3 categories of securities? Okay, I'm going to close this in about 5 seconds. So when we started, we said investments can be categorized. The investments we're talking about in this chapter are categorized as trading securities, available for sale, and held to maturity. So you're going to need to get your answer in. Trading securities, available for sale, and held to maturity. Oops. Yes, that is true. Okay, so then another one here. Now before I put it out there, now this question, and I haven't sent it out yet, an unrealized gain occurs when a company sells a trading security. This could say an unrealized gain or loss. It doesn't matter. The word gain, it could be unrealized loss, an unrealized gain or loss occurs when a company sells a trading security. So the big key words in this question that I have not yet pushed out to you, the big key words are unrealized and sells. So those 2 terms, should they be together is the question. So let me see what I can do here. You're wondering why I'm not delivering this, right? There we go. Okay. Okay, hold on. Okay. Okay, so the question should be out to you. Did you get the question? Okay. I went from 0 to 245 responses. There was like a log and just, yeah. Okay, So the question here, remember in your notes, I said, what does unrealized mean? Unrealized means, and you should have in your notes, unrealized means it's not sold yet. So can an unrealized gain occur when a company sells a trading security? The word unrealized and sell are incompatible. Okay, they're the opposite. Unrealized means you still have it and the market value has changed. So I'm going to close this in about 5 seconds. Okay, so again, unrealized means the investment has not been sold yet, and this is market value. The reason we say that we want so clearly to specify unrealized is we want to make sure that investors know this is a shift in market value. We didn't actually realize this gain or loss. Okay, so we're going to do a homework problem now. Then we'll come back to some more questions. Okay, so this is a real short homework exercise. And first of all, we have an investment company purchase Door Corp shares as a trading security. So they're telling us this is a trading security. We purchased the investment on December 16th for $85,000. In part 1, it says assume that the shares decreased to $78,000. So they bought on December 16th. It's a trading security. December 31st comes along. So we bought for $85. December 31st comes along, and the shares are worth $78 now. So not even relying on a formula. When we look at this, we bought for $85. They're worth $78 now. So we still hold them. So first of all, we have 2 things to determine. We have realized or unrealized, and we have gain or loss. So first of all, since we still hold them, whatever we're doing, it's going to be unrealized. So we have unrealized. And then if it's a gain or loss, this is December 31st. These things are worth $78,000. We paid $85,000 for them. This is not a good situation, right? Because they're worth less than what we paid. So we have an unrealized loss. So what we're going to see here is they want us to do the journal entry to adjust the securities account to market value. So first thing, we're going to debit this account called unrealized loss. And the 85 minus the 78 is not part of the journal entry. This is a journal entry. We're debiting unrealized loss on trading securities. The 85 minus the 78 is just showing you how I got the $7,000. We had a $7,000 unrealized loss. Why is it unrealized? It's unrealized because we still own it. Okay, and then the other side of this is we're crediting the investment in trading securities because the trading securities are no longer worth $85,000, they're worth $78,000. So we're going to credit them. And then we have a memo line. We adjusted these to market value. Okay, so that is part 1. We do this adjustment, and we do an adjustment because we still own it. It's a trading security. We haven't sold it, and it's fallen in value, so we have an unrealized loss. So part 2 says show how we've reported on the balance sheet and on the income statement. Balance sheet is easy. Our investment is under current assets, and it's going to be valued at its current market value of $78,000. Straightforward. We value trading securities at their current market values. Okay, this isn't our entire balance sheet. Our balance sheet would start with cash, okay, but this is just showing what category it goes on the balance sheet. Now, the income statement is a little more interesting. In the income statement side of things, we know we have an unrealized loss. Now, unrealized loss means that something we're holding has decreased in value since we paid for it, or since the last date of adjustment. So what we do on the income statement is it goes on a separate section at the very end of the income statement called other revenues and gains. It's an unrealized loss. Typically, you see loss, well, you see losses with parentheses around them. Losses have parentheses around them because they are negative. So we do have to put parentheses around them because this could have been unrealized gain, in which case it would not have parentheses. So you need parentheses when you're referring to a loss. If you don't do parentheses, it's wrong because then you've just put in a gain. So be sure to put parentheses around losses because they're not the same. If they don't have parentheses, you're saying gain, which is a whole different ballgame than a loss. The other gains and other revenues and gains and losses is in a completely separate section of the income statement, completely separate, because we want to be very careful that our investors know that we actually haven't realized this gain. It's not a transaction that occurred. So that's why it's its own separate section. Okay, so we're going to do a couple questions here now. Okay, so the first question, I haven't pushed it out yet. A company will have an unrealized loss. Okay, so the word unrealized signals to us it can't be sold. Okay, if the fair value of the investment is greater than its cost. So let's talk about this. Cost is what I paid for something. Fair value is worth what it's now. So if you want to answer this in your mind rather than memorizing a formula, if we talk about this, let's just put numbers. Let's say I paid $10 for the investment, so that's its cost. Let's say its fair value today is 15. Okay, so the cost was 10, fair value is 15. So when you think about it, is that a gain for you or a loss? And we know it's unrealized, right, because we still hold it. So that's what that question's about. Okay, so it should be out now. Okay, so on this one, because right now, I want to see if we can get this percentage higher. Right now, 84% of you are right. Okay, so when we talk about this, unrealized, this is unrealized because we still hold it, so that's fine. So there's nothing, unrealized is a good word there because we're still holding it. Now, the deal is it a loss? Okay, now let's put some numbers on this. Let's say the cost is $10. And the fair value is 15. So cost is what you would have paid for it a couple weeks ago. So it costs $10. The fair value right now is 15. Okay? So you paid 10 for it a couple weeks ago. Its fair value now is 15. Was that a gain, meaning it increased in value, or was that a loss, meaning it decreased in value? We know it's unrealized. So, okay, we got a couple of people changing to the right answer. We're up to, okay, so I'm going to ask you. Okay, so you're on the spot here. Are gains good things or bad things? Good, right? We want a gain. Okay. So if your original cost was $10 and it's now worth 15, is that a good thing? It is a good thing, right? So good things are gains, right? Now this question says, is it a loss? So is this a loss? No, it cannot be a loss. It's not an unrealized loss. So let's see if that helped. Okay, we're up to 92%. Going to be closing this in about 5 seconds. So you helped a bunch. We're up to 95%. Okay. 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 Again, it's false, okay, because we said put some numbers and walk through it in your head. It's unrealized because we're still holding it, so that's good. But if we paid $10 for something and it's worth $15 now, that's an unrealized gain. That's a good thing. It is not a loss. A loss would be if we had paid $15 for it and now it's only worth $10. Then, boy, we've lost on that. So let's do another one here. Okay, now, I've not pushed this out on purpose. So let's look at this. ABC Company purchases a trading security for $12,000. The entry to record this transaction. So it's asking for the entry for this transaction. So if we purchase a trading security for $12,000, that entry is going to debit the investment and credit cash because we're spending cash for it. So that investment is going to that transaction, we're going to debit the investment and we're going to credit cash, right? So that's what's going on here. We did one of those to start the day. But that's what's happening. We're getting an investment. This current asset is going up. Cash is going down because we paid cash for it. So we are now going to have this question out here. Okay. So now the question's out there. You should be able to answer it with what's on the screen there. Okay, again, what's on the screen here will answer the question. You will get it right if you're looking on the screen. The journal entry to record this transaction will debit the investment account, credit cash. I'm going to close this question in about 5 seconds. There's securities laws that prevent that, so we're not, typically we don't buy securities on account just because the SEC frowns on gambling, like borrowing money and investing. I mean, you could do it in certain circumstances, but it's going to be some kind of payable account. But typically, for our purpose, we're not doing that. Okay, it can happen, it's just not. Okay. Okay, so of course that was a debit to the investment account. Okay, we're going to do another one here. Now this one's a lot of reading, but I want to say that this one's pretty not bad at all. First of all, you see the word unrealized gain. Okay, so maybe I'll push this one out, and then I'm going to talk you through it. Okay. Okay. So the word unrealized gain. Okay, so let's say unrealized. Let's tackle that word first. Unrealized means it can't be sold, have been sold, right? Unrealized means we still own it. So if we read question A, or item A, is recorded when a trading security is sold, right there, is sold, that is not compatible with unrealized. For entry B, is recorded when a trading security is sold. Again, so right now, unrealized means not sold yet, right? So we know that. And then how do we get a gain? And when we're talking about a gain means comparing our cost or carrying value to the market value or the fair market. And when a gain means that our cost is less than fair market value, or fair market value is greater than cost, whichever way you want to look at it. But when we talk about a gain, it's because our cost is less than fair market. So we have the word unrealized, means what? Not sold yet. Okay. And then the gain. So when you walk through this question, okay, it can't be A or B. We know because we have the word unrealized, it can't be sold, so we can eliminate those two. Now, the next two answer choices We have when the fair market value of the trading security is more than its cost, and we have the fair market value of the trading security is less than its cost. So we're looking for what causes a gain. A gain, we've made a gain if the fair market value is greater than what we paid for it, right? Then what we paid for it is its cost. So when we're looking here, we're going to be closing this question fairly soon, but the fair market value of the trading security, we want the fair market value to be greater than what we paid for it. Isn't that the goal of all this? Is a gain is going to be when it's worth more than what we paid. What we paid is its cost. So I'm going to close this in about 5 seconds or so. Again, you're going to have an unrealized gain occur when you've got your fair market value greater than what you paid. So the answer is C. Okay, so now we're moving on to the next part of the chapter. The next part of the chapter, we talk about revenue recognition because this deals with accounts receivable. Accounts receivables, we'll get there. But revenue recognition. And it seems like it would be easy to tell when revenue is recognized. It's recognized when the goods or services are provided to the customer. Then we have these other two criteria that we're not going to use too much, but just know that they exist. The price is fixed. We can't say, oh, we'll sell it to you. We'll agree on the price someday in the future. That's not, we don't recognize revenue until the price is fixed or determinable, and that collection's reasonably assured. So a company can't set up a bunch of sham sales and then recognize revenue and then later go, oh, we couldn't collect. You have to be reasonably assured that you're going to collect the revenue. So the big key is that the goods are transferred or the services provided to the customer. That is when we recognize revenue. Okay. So basic journal entry, and we had this to begin a couple weeks ago when we sell goods to a customer, basic journal entry. Let's say Apple is selling 30,000 iPhones to an AT&T wireless warehouse. They're selling to AT&T wireless $100 each. So Apple, we're doing the accounting for Apple here. So this is accounts receivable. They sell these 30,000 phones at $100 each. That's $3 million. So what they're going to do is they're going to debit accounts receivable, and they're going to credit sales revenue for the $3 million. Okay. Now, when we get into our inventory chapter, we're going to have another entry that deals with inventory, but for right now, we're focusing on the selling side of this. When we sell this, we now have a receivable, an accounts receivable, which means AT&T owes Apple $3 million, and Apple recognizes sales revenue. So that's all pretty straightforward. We aren't given a date, so we don't have a date to put in here, but that's a basic sales entry. So they sell on account. So on account means they're selling on account, so we're going to debit accounts receivable and asset, credit sales revenue. Okay, now we're going to have a couple little twists now in the chapter. So now that was our basic sales entry. That's all fine. But we can make a couple little twists, and so here's the first of those coming up. The first of those are, we said that we recognize revenue when ownership transfers. I guess when we deliver the services or deliver the goods to the customer. When does that happen? There are two terms here. The first term is FOB, shipping point. And FOB stands for free on board. You're just going to see FOB, shipping point. You won't see it spelled out normally. So FOB, shipping point means that we recognize revenue, we, being the seller, recognize revenue when the goods leave the seller's shipping dock. Now, something key here is when we leave our shipping dock, that means we're shipping it. The customer isn't standing on the shipping dock waiting to receive their goods. The customer's across the country. So FOB shipping point means when FedEx picks it up, or when UPS picks it up, or when some common carrier picks it up. So the ownership changes hands and revenue is recognized at the shipping dock when it's FOB shipping point. Once those goods are picked up by UPS, by FedEx, by the common carrier, then revenue is recognized. We are going to have a slew of questions today on this. Okay, so you need to know FOB shipping point. Revenue is recognized when the goods leave the shipping dock, the shipper's dock. Okay, and the customer is not standing at the dock to get the goods. The customer is across the country or wherever they're located. The goods, once UPS picks up the goods, revenue is recognized. When you buy online, you buy from Amazon, Amazon is actually selling to you FOB shipping point. They charge your credit card when they ship, and that's what's happening is it's being picked up and you get charged. So Amazon can recognize revenue then. Okay, so that's FOB shipping point. So if you see questions that say, when do we recognize revenue when it's FOB shipping point, it's when the goods leave the shipper's shipping dock, okay? Then the other one we have is FOB destination. So what happens here? FOB destination is when the goods arrive at the customer, okay? So we recognize, so if we're selling FOB destination, revenue is not recognized until the customer gets the goods, receives the goods. So what I'm going to do now is I'm going to push a question out. Okay, so I'm going to come back to this in just a moment. The question I'm sending out is, when goods are shipped FOB destination, revenue is recognized by the seller when the goods leave its shipping dock. True or false? And again, refer to your notes that look like this. And again, you should have this written down because we're going to get lots of questions on this. We're going to see a lot today. We're going to see a lot on Wednesday. Right now, 82% of you are correct. Okay, so our question says when goods are shipped FOB destination. So the question is actually asking you this bottom scenario. Okay. When goods are shipped FOB destination, okay, so when is revenue recognized? So just reading that chart, FOB destination, revenue is recognized when? Revenue is recognized by the seller when the goods leave its shipping dock. True or false? And again, look at this section of the notes. We're talking about when revenue is recognized. FOB shipping point, the top one, at the point we recognize revenue when the goods leave the seller's shipping dock. FOB destination means we recognize revenue at the point of delivery to the customer. Which one we use is dependent on the terms of the invoice. So if the items are sold FOB destination, revenue is not recognized until the goods reach the customer, okay? So if we sell FOB shipping point, revenue is recognized when the goods leave the shipping dock. So the question that you have here is asking, if you sell FOB destination, when is revenue recognized? I'm going to close this in about 5 seconds. Okay, so that one is false, okay, because FOB destination, you recognize revenue when the goods arrive at the customer. FOB shipping point is that you recognize revenue when it leaves your shipper's dock. Okay, so next up in this chapter, so now we have another twist on revenue recognition, and this twist is sales discounts. Sales discounts, very specific term. It does not refer to a markdown on merchandise. Sales discounts refers to discounts offered for early payment. Okay? Typical terms would be, and in that box, how you pronounce that is 210 net 30. And what that means is that you get a 2%, the purchaser gets a 2% discount if you pay within 10 days. Otherwise, the full amount is due in 30 days. Okay, so this is a typical incentive. This is not all incentives, but typically what companies will do, they want to speed up their cash flow, because if I'm selling merchandise, I have to pay my own suppliers. So I want to speed up the cash flow. So I will say to my customers, hey, if you pay me within 10 days, I'll give you a 2% discount, which is a really nice discount on an annual basis. That's a really nice discount. Otherwise, if you don't pay within 10 days, you have to pay the full amount and it's due within 30. So this could be 115, for example. 115 would be 1% discount if you pay within 15 days. That N30 at the end simply says you have to pay the full invoice within 30 days. Your discount is only in the first 10 days in this case. So it could be 3% discount if paid within 5 days, net 45 or something like that. You can have all different terms, but the first two terms are the discount and the number of days for the discount, and the back term is how many days in total you have to pay, but you have to pay the full invoice. So let's go through a little example here. Let's say this 210 net 30 discount, let's say Apple offered AT&T 210 net 30 and AT&T pays within 10 days. Now remember, AT&T just bought $3 million of iPhones. So the discount on $3 million, a 2% discount, is $3 million times 2% or $60,000. So when Apple collects the money, what's going to happen is AT&T is going to pay Apple $2,940,000, which is the original invoice amount less that discount of 2%. So Apple's going to get this. They're getting it within their 10 days, so they're getting their discount to $2,940,000. And then we're also going to debit an account called sales discount. Sales discount is a contra sales revenue account. Okay, sales discount is always shown with sales. It reduces sales overall. So then our credit will be to accounts receivable for the full $3 million. We need to take the full $3 million out of accounts receivable. We're debiting cash, and then that difference is the sales discount. Okay, so sales discounts. So you need to know what a sales discount is. It's to encourage early payment. It's a discount given for prompt payment. Okay, so we're encouraging customers to pay us faster. So that's sales discount. Sales discount is a contra revenue account. One more twist in revenue recognition are something called sales returns and allowances. Customers have the right to return damaged merchandise or merchandise that's unsatisfactory, and so companies need to record those. So let's assume 100 of the iPhones are returned from this original invoice, and 100 phones at the $100 each. So we're going to have sales returns and allowances, $10,000. So we take the total of what's being returned, we put it in sales returns and allowances, which is again a contra sales account, and it goes in sales returns and allowances, and it's going to be crediting accounts receivable because they don't. AT&T doesn't own Apple for the phones that are returned. Okay, now we're going to do some questions, and we're going to do a couple questions back to FOB shipping point and FOB destination. So prominently in your notes, FOB shipping point means we recognize revenue when the goods leave the shipper's dock. FOB destination, we recognize revenue when the goods arrive at the destination, at the customers. So the first question we're going to have is, which of the following is true regarding FOB shipping point? Okay. So FOB shipping point, you should look at that part on the slide we had where we had FOB shipping point was the top part of it. So look at the part that goes across FOB shipping point, the part that was right next to it. Goods, revenue is recorded when the goods leave the seller's shipping dock. Okay, on the part of the notes, it said FOB shipping point. Right next to that, it said revenue is recognized when the goods leave the shipper's dock. That's FOB shipping point. So, which of the following is true regarding FOB shipping point? When we look at answer A, ownership changes hands when the customer receives the merchandise. FOB shipping point means we recognize revenue when the goods leave the shipper's dock. It has nothing to do with when the customer gets it. That's what FOB shipping point means. So in this whole scheme of things, it can't be A. Revenue is recorded when the customer receives the merchandise. Again, it has nothing to do. FOB shipping point means that we recognize revenue when it leaves the shipper's selling dock, and ownership changes when it leaves the shipper's dock. So FOB shipping point means everything happens at the shipper's dock. Ownership transfers and revenue is recognized. If we were talking about FOB destination, all of that, the ownership changing hands and revenue recognition, if we're talking FOB destination, that happens when the customer gets it. Okay, I'm going to close this question in about 5 seconds. Okay, of course, it's C, ownership changes hands when the merchandise is shipped, okay? Okay, so then we have another one. Practice some more. ABC company has shipped goods to one of its customers, FOB shipping point. Okay, so we ship goods using FOB shipping point. FOB shipping point means, without even looking at any of the answers, FOB shipping point means that ownership and revenue is recognized, ownership transfers and revenue is recognized at the shipping point, which is at the shipper's dock. So, ABC shipping dock, all of that happens. Okay, ABC company has shipped goods to one of its customers, FOB shipping point. ABC company will recognize sales revenue when? Again, looking at that chart, it's FOB shipping point. I'm going to close this question in about 5 seconds. Okay, so it's when FOB shipping point means when our goods leave our shipping dock. We didn't say anything about the customer receiving and inspecting the goods. This is FOB shipping point. C can't be because that's never going to be. We have shipping terms. We can abide by the shipping terms. It's not going to be D because it doesn't matter when the customer pays the invoice. That doesn't have anything to do with our revenue recognition. Okay, one more before we go on. A business offers credit terms of 115 net 30. These terms indicate what? Okay, so when we see credit terms of 115 net 30, the 115 part means we get a 1% discount. This is the customer gets a 1% discount on their invoice if they pay within 15 days. If they don't pay within 15 days, they don't get a discount, but they have to pay within 30 because the second part, the net 30, means the whole invoice is due within 30 days. So you get a 1% discount if you pay within 15 days, and then the whole thing is due in 30. But, so, when you answer this, okay, you can only take, the customer can only take the discount, only take the discount if they pay within 15 days. Okay? Otherwise, they have to pay the whole thing within 30 days, but that discount is only valid in 15 days. Okay, I'm going to close this in 5 seconds. Okay, so the discount of 1% can be taken if the invoice is within 15 days. C is not right because you don't have 15 or 30 days to get the discount. You only get the discount if you pay within 15 days. Okay, moving on to our next section. Now we're into accounts receivable. Accounts receivable are generated when we sell goods or services to customers. And accounts receivable are going to be down just a little bit below on the balance sheet. They're still current assets. They're down below cash. They're down below short-term investments. And so it's typically the third, receivables in general are the third most liquid asset. They're monetary claims against others. And there's two main types of receivables. There are all kinds of receivables, but there's two main ones that we're looking at. Accounts receivable and notes receivable. And we're going to do both in this chapter. So accounts receivable is when we sell goods and services to customers. Notes receivable is when we loan money to someone. There are two, we're looking at accounts receivable and notes receivable. The initial entries to record these we've seen before. First of all, if we perform service on an account, we're going to debit accounts receivable, credit service revenue. If we loan money on our notes receivable, we're going to debit note receivable and credit cash. So those are just the entries that set us up when we set up the note receivable or the account receivable. Okay, we have a little bit of terminology next. So next up, terminology. We have this terminology called subsidiary accounts, and that's the term you need to know. On a company's general ledger, which is what's on their balance sheet, we will see the account called accounts receivable. And in this case, this company is owed $9,000. So that means customers owe it $9,000. Now when it goes to collect that money, If all we knew was customers owe us $9,000, we wouldn't be able to collect the money. So what we do is we keep track in these little ledgers called subsidiary ledgers. It's where we keep an account for each customer. So Brown is a customer, FedEx is a customer, Moody's is a customer. Brown owes us $5,000, FedEx owes us $1,000, Moody's owes us $3,000. So the subsidiary ledger, if we add up all the accounts in the subsidiary ledgers, all the customers' accounts, they will total the accounts receivable on our balance sheet. So that's how we know how much to collect, how much each customer owes us. That's how we can verify that our accounts receivable is right. So we have subsidiary ledgers which are detailed for the accounts on the general ledger. When we're talking about accounts receivable, it's a listing of the details of all the transactions with our customers by customer. So it's just detail for what's going on in the general ledger. So that's accounts receivable has subsidiary ledgers, which is the detail for what's in there. We also have notes receivable. We have a little bit how notes receivable differs from accounts receivable is we have a written promise. So we have this idea that this is in writing. A notes receivable has to be in writing, a written promise. It includes an amount plus interest, and it has a maturity date. So typically accounts receivable, they have a due date. They have, you have to pay within 30 days, but they don't typically carry interest. Notes receivable is a formal written promise to pay, and your customer is promising to pay you, and whoever you've loaned the money to, and it's going to have interest on it, and it's going to have a maturity date when it's due to be paid. Okay, now, so the rest of the chapter, we have accounts receivable. We're going to talk about, like, what happens when a customer doesn't pay you what it owes you. And then we have notes receivable, which are accruing interest and those kind of things. So we're going to cover both of those on Wednesday. So at this point, we're done with today, and I will see you on Wednesday.